In May of this year, IRB issued the first insurance risk letter, LRS, or in English, Insurance Linked Securities, ILS, linked to the surety bond. A topic that closely connects with what was discussed in the last episode about capacity shortages for large companies, large groups, and borrowers in the guarantee market. And to talk about this subject, we have with us today Luciano Valina. Luciano Valina, Network of Guarantee Lines, Credit, Housing, and Bond, IRBRE Lease. Luque, thank you for accepting the invitation to be with us today. It's a pleasure to have you here.
My pleasure, Carol. Thank you for the invitation, for the opportunity. Let's go.
Very good. In the last episode of our podcast, we addressed what to expect from the automatic contract renewal period, right? That were coming up at the time. And one of the points that was widely discussed was the shortage of capacity for some major clients, right? So we mentioned briefly that there are some companies whose demand for judicial guarantees, especially, is greater than the size of the market. Brazilian insurer. So even if we added up the risk-taking capacity of all the insurers, considering their automatic contracts, it still wouldn't be enough for the pipeline of demands that these big names have. And it was very timely. Our conversation was well-timed and paced in that last episode because of the first ILS in Surety Insurance in Brazil with IRB. And it would be very interesting for our audience to understand in more detail how it works. Insurance-linked securities, ILS in English, or insurance risk note, LRS in Portuguese. If you could explain a bit about the structuring, how does it work?
Is it not the case, in your considered opinion and assessment, that the preceding statement, proposition, or assertion, which I have just articulated, presented, or implicitly conveyed, is indeed accurate, correct, valid, and aligns precisely, unequivocally, and comprehensively with your understanding, perception, perspective, and overall comprehension of the subject matter topic, or point currently under discussion and consideration? I am earnestly seeking your explicit affirmation, confirmation, validation, and corroboration to ascertain, verify, and ensure with absolute certainty that we are in complete, mutual, and unequivocal agreement, accord, and alignment regarding the veracity, precision, soundness, and overall correctness of the information or assertion that has just been put forth for your consideration. Are we not in such a state of shared understanding and consensus? In our economic group, we have Andrina, which is an insurance company with a specific purpose. It is the entity responsible for issuing this note. And this note, in fact, is specifically designed to protect insurable risks and naturally reinsurable risks as well that are presented to it. And in this protection to, let's say, safeguard this exposure that is being, in quotes, protected, you go to the financial market, you go to the capital market to look for investors who are willing to take on this insurance risk, so to speak. By investing in the reinsurance risk note, this is, let's say, in a broad sense, maybe a bit simple and summarized in definition, how it is structured, how the business works. It is
super interesting then, because ILS expands the size of the market since new sources of capital are coming in, which come from the capital market as if we were tapping into new pockets, those of professional investors can invest in this security.
Yes, you actually bring new capacity to this market. As you mentioned at the beginning, very accurately,
There are.
Surety bond clients, for example, who have much more demand than the market can supply for them. And it may be that the reinsurance note, or rather the insurance credit note, or finally the insurance risk note, could actually meet this demand, which today is held back precisely due to a lack of capacity, a limited capacity. For this group of clients,
Yes. I think an interesting parallel is that the insurance and reinsurance market takes on risks based on the balance sheet. Companies taking on the risk. For insurers and reinsurers, establish solvency rules. Being part of a supervised market. In ILS, the structure is different. It's a structure where the capital market, the investors, provide the collateral for the operation. So that's why it brings in new money to the market. Money coming from investors that will collateralize the risk, which will be transferred by the cedent, which can be an insurer or a reinsurer, to these investors through ILS. If you could explain in your case who are the main players who ensures governance in this operation in more detail, mentioning the specifics of the structure. So, we have IRB as the sponsor, the cedent, ceding part of the risks from its portfolio.
can I comment? Let's talk about the specific case of IRB because illustrating makes it tangible. Exactly. You want to ensure people can see what we're talking about. It's like you have to touch it, they have to see it. So, taking a step back, IRB is a reinsurer. IRB also buys protection for its own guarantee portfolio.
Yes,
It doesn't retain all the risks it takes on in the reinsurance contracts it participates in.
reinsurers that spread the risk. They spread the risk.
And also for capital management, portfolio management, among other reasons. It also seeks protection for part of its exposures in order to reach the appropriate risk level according to its profile. So far,
This done retrocession.
yes. They continued using retrocession contracts, but now with the introduction of insurance-linked securities, they also used this new tool to literally test the market with this first operation. So in a straightforward structure, we have a non-proportional contract, which is part of the protection for which is the retrocession contract that. Retrocession contract with participation from several retrocessionaires globally who have supported us for a long time. Carol's former company supported us for a few years. It's worth mentioning, while she was working in Brazil with us, she even led our retrocession contract recently. So I feel very comfortable discussing these topics. So we set up a structure where, through our subsidiary Andrina, which is a special purpose insurance company, we took part of our risk that we placed in the retrocession contract and offered it to Andrina so that it could, in fact, issue an insurance-linked security attracting investors or seeking investors to provide us with protection in a similar way, similar to what we have in the retrocession market. Yes. So at the end of the day, that's our goal. And like we might be asking ourselves, wow, but when we start talking about ILS, about securities and all that, one of the main principles that guide this type of activity from the investor's perspective is diversification, because the capital market investor is already involved in the financial market. They already know it. They live it in their daily life. So when they move into the insurance and reinsurance field, naturally they might aim for, and it makes sense, this happens in the European and American markets, they make it so that they seek diversification in their portfolio, stepping a bit away from financial risks. In other words, they move away from risks like interest rate fluctuations, inflation, and other such issues, and start allocating part of their capital to catastrophe risks, among others.
which today is the majority of
cases. Most of the ILS market is linked to catastrophic risks, and that makes perfect sense, which makes perfect sense. So what happens when we structured this operation? What were the factors that actually led us to start with Surety Insurance? First, trying to look at it, or rather, from the investor's perspective, in our view, it's much easier for the investor to understand a market risk from the financial market, which he's already a part of, rather than being introduced to a catastrophe risk, a property risk, or a risk that's different from what he deals with every day. So I think this kickoff and this guarantee framework have this educational aspect. You're presenting the investor with a risk that's closer to his everyday life, things he naturally deals with. So what did we do in this situation? We listed out some risks. When we talk about risk here in Surety Insurance, we're referring to groups of obligors. We selected 14 obligor groups with excellent credit risk quality, already well known in the capital and financial markets. Naturally, we offered them the opportunity to analyze the operation specifically to protect against a default by these obligors. Because at the end of the day, if we look at it from the investor's perspective, what is he ultimately going to do? Weigh things from his side, even though there are some even better features when it comes to surety, which I can give examples of later, right? But what he's ultimately going to focus on as his main concern is the probability of default by these guys. They know it. Their portfolio is monitored, tracked, and invested daily, potentially from a debt. He already knows everything. So, like, for him, what's his risk? The risk is if, in fact, one of those 14 guys he knows so well were to default, which he already knows. So he feels comfortable taking a step forward because he's already halfway there.
And yes, what you are so astutely pointing out here is of paramount importance, precisely because the comprehensive profile of these specific economic entities we are discussing, particularly the prominent 14 main economic groups, reveals a distinct and deeply ingrained characteristic. This profile is meticulously and unequivocally focused on the robust establishment and unwavering preservation of comprehensive judicial guarantees, which are absolutely essential for their operational stability and long-term viability within the intricate legal framework.
Yes. They're major Brazilian companies, but they have, let's say, a very significant amount of legal disputes. Yes. So that's exactly their profile. So this double trigger, when I mentioned a few minutes ago that it's still better in guarantees than in the market, it's because there's the default issue that the market already knows about, but there's an earlier trigger, which is this: they have to lose that lawsuit. In other words, there's a merit risk. If they win, there's no problem, nothing to discuss. So they have to lose the lawsuit. Once they lose the lawsuit, it goes through all appeals and they still don't pay. Yes. In other words, you have an additional trigger here.
For
This to cause kind of loss, if you can even use that word, that would introduce risk to the principal. When we offered this structure for the note, we didn't offer it primarily to the financial market. In our protection structure, we have different levels of risk exposure. The goal is even to protect at this initial stage so that the product is born in a healthy way and continues well, so to speak, with a chance to mature and bear new fruit. We never offer the primary layer, which would be the layer most exposed to potential claims. We call it the afflixo, right? Which is going to have more activity there. It would theoretically have a higher turnover there, a greater increase in opportunities, problems, if we can use that word. So we are offering higher layers.
in our protection, as an additional factor of risk quality that is transferred to the capital market. Yes, Because since it is further away, even though the profile of these companies is non-default that's the
main point, right? Because these companies, at the end of the day, even use surety insurance as part of their daily routine. Because if you look at it from another angle, stepping away from the letter a bit, more towards surety insurance now, just a quick comment, right? When you're dealing with a legal matter, you have to make a deposit there in order to keep moving forward with the case. It's much cheaper for you to put up the insurance policy than to take the financial amount and make a judicial deposit. You take that money and invest it in your production, invest it financially, and you'll get a much higher return. If that company eventually has a problem, has a claim, it could end up blocking this market for them, right? So like it totally makes sense, right? The risk of default, the risk of default with these guys is minimal, right? They don't even have that
attrition characteristic. But even so, in a loss scenario, right? In a case of insolvency, where the merits would be, let's suppose, right? Insolvency of the economic group, of the guarantee holder, one of those 14, for example, they would still have to have a cumulative loss event greater than an attachment point, as we call it, which would be there. From that value on, losses above that amount are what would be passed on to the capital markets. So we're also moving away from a scenario that's not even about this attritional activity, but really about PML. Very good point. When you look at the entire aggregate of that borrower at the limit where they win half and lose half of the merits under discussion. So in that case, for example, you would have a PML of 50%, which would eventually be related to this attachment point, which is established as losses from which the collateral, which was set up through it was capitalized through the issuance of the notes, so it would then be affected.
Yes, that's it.
So, and in addition to that, moving on to another crucial point that I believe further strengthens and reinforces your argument significantly is the fact that we are actively offering to the note, so to speak, a substantial and integral part of our exposure. This means that we are effectively sharing a portion of our risk and potential upside with the note holders, thereby aligning our interests and providing them with a direct stake in the underlying assets or ventures. This strategic move not only enhances the attractiveness of the note, but also demonstrates our commitment to transparency and shared success. Yes, absolutely. This is a key aspect of our strategy and a fundamental element of the offering. Yes, you get it?
So it has this portion. Let's say hypothetically that I have 10% of the market. So if I'm offering to my retrocessionaire or to the letter a range in excess of, I don't know, 200 million or 300 million, that's 200 million of my exposure. So if you have
IRB loses 200 million reais. Considering that it is 10% of the market, that would be a loss for the surety bond market of more than
2 billion reis. Besides the guy I say, the borrowing company has a good credit rating, a low chance of default, and has a double trigger, as we mentioned in the trigger, in relation to the legal issue, which is what most consumes the exposure of these borrowers listed in this group. There is still this issue that my market share is not complete. Does mine, naturally, your market
my market.
share isn't 100%. There's still this part that to get the whole pie, the claim,
We call it sinistro from ground up, which would be the market's total claim. for your retention when compared to the attachment point to be higher than what was established. It would be here, obviously, we don't disclose the specific numbers of the case, but in this hypothetical case we were discussing of 200 million in losses, it would be a 2 billion claim, just so the audience has a reference for the relationship between a market claim, IRB's retention, the attachment point, and losses. From that amount on, that this collateral established, raised by investors, raised through the note in the capital markets, would be affected. So, super interesting. And then I think there are 2 points that are worth us discussing as well. When, all this time we've been discussing ILS, its applications, and everything else, I think the market has talked a lot about 2 points. The first is the long tail or short tail nature of the risks that will be transferred to the capital markets. And here, considering that when we draw an analogy with the catastrophe market, it ends up being very short tail, right? When you say, was there a hurricane or not? The coverage period was shorter, right? You have the nature of the event happening during the term of that instrument. And when we look at the nature of surety insurance, where we have a more long tail characteristic, how is that translated? Yes, in the structuring of the note. And I think there's a strong analogy here. With the fact that this note is part of your risk transfer from a reinsurer. In other words, it's within a retrocession universe, where the nature of the protections of retrocession are much more short tail due to than in a risk transfer market between insurers and reinsurers because of the loss occurring characteristics. Claims that occur during the period of the established protections. Both retrocession contracts and, by analogy, the notes that are
The retrocession market, for most, it focuses on the occurrence basis, not on a risk attaching basis like we do as reinsurers dealing with reinsurers. So if I'm working in the retrocession market on a risk attaching basis, which gives me protection, a basis, our coral, with 12 months of protection, the contract for 12 months, it ends up being pretty much equivalent to what I already have today.
an instrument that makes up your entire
Risk transfer, yet it offered nothing new. A big challenge in terms of structure because it's a structure we already use. And the reinsurance market, when it buys protection for itself, which are the retrocessions, already uses this on a large scale. So as far as structure goes, it just fit right in. Similarly, to simplify, it's like having a retrocessionaire within my protection panel.
yes, as if it were an additional layer.
An additional layer or a part within a layer. Part within.
A layer or
I think this characteristic also made it easier for us to arrange this placement.
super interesting. So, one of the points we discussed a lot as a market when we talked about ALS for surety insurance was the issue of the tail. I think that in your case, when I saw it in the news, I thought, wow, it made perfect sense. Because the tail was a point that had a lot of synergy with the portfolio protection characteristic. And the other point I found interesting, which I think is worth us mentioning, was another point that was heavily discussed by the market regarding what risk premium would make the capital markets attractive and, at the same time, make sense for the business, considering it as if it were the net position of the cedent. Whether the cedent is a reinsurer or an insurer. And here, I'm going to share my impression here, and then please feel free to comment. But I think it's interesting because instead of us comparing the risk premium of a note with the primary market rate, the surety insurance rate from the primary market, we compare The risk premium of the note with the online rate of retrocession programs. Exactly. And why does this comparison make sense? Because first, it would be analogous to the analysis done on the portfolio. And in addition, it's because it's as if it were enable. It's what allows you to increase your participation in a contract. In a contract at the end point that will generate you being able to take on more capacity in those 14 names that are usually, that's what limits the growth of your portfolio. Being able to expand this capacity allows you to generate in a premium, which is the premium given by the insurer to the reinsurer, which is your source of revenue, a much more significant volume. Then the cost of this, let's call it rate online, of this risk premium associated with the letter. So what I think is that, once again, within the retrocession market, when I saw the name, I thought, wow, it made a lot of sense.
Fit really well. Yeah, it made a lot of sense. And what you're saying is perfect, Carol, because you can't compare if you eventually think, wow, it was even reported in the press, right? The NOSA operation had a return of CDI plus 2.5%. Yes. If you think, wow, plus 2.5%, I can't get that premium with these guys. Perfect, but that's not my goal. I'm not directly facing that headache. Yes. My point is, first question, how much do I pay in retrocession fees when I buy from these guys here? If I pay something below, I think 2.5 for you doesn't make sense. If I pay up to 2.5, I break even. If I pay more than that, I'm actually, in quotes, getting an advantage with Cadita because of the cost issue. And another point you made very well is notice in the reinsurance market, sometimes the biggest premiums aren't coming from these names. Yes. Because these are names that have a very large accumulation. There's little room for new issuances. They're excellent credit risks, no doubt about it. The market doesn't do more because there's no capacity. Yes, but that's not where the bulk of the premium comes from. The bulk of the premium comes from the lower tranches of contracts where you have all other companies operating. Other borrowers with smaller accumulations you could participate in. So that's where the business interest lies, right? And sometimes the insurers, when they go to buy their reinsurance contracts, increase their capacity because of these guys here.
Yes.
And the reinsurer might already be committed to these names and can't increase capacity as 10 guys block them.
Yes, that ends up being an obstacle to maintaining or even expanding there. If I can find a solution for this guy.
Here, which isn't going to be a huge solution because it won't be a big capacity for him since the contract is already full, I increase my participation and benefit from this whole chunk here at the bottom of the portfolio. This mass of premiums here will surely subsidize the operation, but it made sense to me. That's another point. And a third point, which might be a bit of an extra, so to speak, is notice securing the tail. Whoever stumbles, those who work with Surety Insurance know that we have a tail, a slightly longer tail here in our terms, right? So I even joke with people, if we stopped working with Surety today, we would still be buying protection for a while longer. I stopped working, I don't buy protection anymore. No, I'll have to keep buying it until my exposure drops to a level I consider extremely appropriate. Right there. In other words, I'll be buying protection from now on, regardless of whether I'm doing business or not. So if I find an alternative path here that eventually makes sense to me in terms of the cost of buying protection, and it opens up space for me to eventually do more business, taking on the borrowers who are in the pool of contracts, let's say, who give me a better return than these guys, it makes sense. It should be in a quick way that the operation makes sense.
Yes.
By that logic.
Investing in this risk premium increases your ability to expand your participation in contracts. Contracts, yes. Increasing the revenue generated in your portfolio of.
Surety Insurance. In my portfolio.
Of surety insurance.
This.
Maybe isn't so straightforward, but that's why I want to dig into it for our audience, the how. The operation of the retrocessionaire, of the reinsurer, is different from the operation of the insurer. The insurer eventually might say, no, it doesn't make sense because if you look at the end, me doing this operation doesn't make sense. Because the relationship between the rate in the primary market, the insurance rate, and the risk premium to attract the capital market, maybe the deal just doesn't add up. But when I see that having capacity for these names allows me to expand my participation in contracts, I can get a return on that investment that was made. Interesting.
On our side here.
Another aspect I think is interesting for us to discuss is regarding when we talk about a structure that has a more loss-occurring nature than risk attaching, which is risk attaching is pretty obvious, right? It's tied to emissions during that policy period, and it follows the entire term of the policy, the loss occurring. It has a very strategic and important point, which is the definition of the characterization of the claim, which is what will link that claim to that policy period. Exactly. And in the case of the bond, how is that designed and how is it presented to the capital markets? Because these are sophisticated concepts, right?
Yes. The thing is, we spent a good part of our time in this business traction phase precisely trying to convince or talk to investors, bringing them the perspective of an insurance company, right? Especially from a reinsurer's point of view, right? Just like we learned their terms and expressions from them. And how the capital markets work, they also learned that with us. How we handle our risk retention, how we treat risk from the perspective of an insurer or a reinsurer. Yes, regarding the matter of the note. The way we handle claims, let's say, the way we communicate a claim, it follows the same procedure we use with our retrocessionaires. If we have information about a claim that occurred during the validity of the note, we will literally flag it, and if necessary, the note as well, to seek recovery of the amount from what has been invested by the investors. It's a bit redundant here, but I think it's clear. So, I think the rationale remains the same. What you might have here is just a slightly different process for getting things done, so to speak. What happens? In a normal retrocession operation, once the contract is flagged, naturally, that retrocessionaire will stay with me until the end. This resolution might take 5 years, 10 years, however long it takes, that retrocessionaire will stick with me. For the note, we have a limited period, stipulated in the contract. Also, because of the nature of the investors, they don't want to be tied up in a deal for 10 or 15 years. Very objectively, the investor's view is this: look, the risk starts here, and the risk ends here. If I win, give it to me. If I lose, here you go, literally. I'm putting it here in a very simple and colloquial way. So, this is the point where we had to find a balance to accommodate the issue of the note in our retrocession panel. How are we mitigating or handling this? If we eventually have a claim that affects any of the names listed in the note, we present our IBNR to the investors through the trustee. In other words, there is an IBNR calculation done for this matter, and this IBNR calculation follows the same assumptions we use for our entire portfolio, meaning there is no kind of disadvantage or advantage for being a note or not being a note. If in this IBNR calculation, if the portion of the note, the range that it's protecting us from, is affected, the investor will have their asset, let's say, their investment frozen until we are able to resolve that issue. In other words, it will reach the end of the term. Here, we will calculate and say, look, my expected loss for this party with your IBNR is such and such. Hey, this amount falls within a range that includes you. I'm going to hold your amount here with me. Ah, we've calculated the IBNR. Well, my expected loss here is lower than the range you're participating in. You'll leave with your amount, naturally adjusted by the risk premium and any other contractually established charges. So, that's the point. We're not actually going to, in fact, if we were to put it in terms of claims provisions, set up a PSL.
PSL is, the notice has arrived. In this case, maybe the notice that would reach his range hasn't arrived yet. But we have a BNR calculation that will develop this claim up to that point.
Sometimes, not necessarily, when you formally link the claim to your BNR provision, it doesn't always inherently mean we're directly tying it to the initial claim notification or the official opening of a case reserve. Break time equals 0.5s/. You might be linking it to a deterioration in the credit quality of the borrower, which could eventually factor into your equation. Into your IBNR because it's incurred, but not reported. So, a loss in the credit quality of that borrower. It can impact your IBNR methodology, broadening the possibility of triggering those policies that haven't yet, due to the gap between triggering the policy. They are consumed, they are reached. Exactly, maybe you haven't yet. But
the rule, just to make it clear here, so there's no doubt about this, all of this is contractually established. The rules of the game, they appear both in the risk transfer contract. In other words, I believe this is the first time this term is being used here. This contract happens when, in this practical case of IRB transfers part of its risk to Andrina, which is the SSP, the Special Purpose Insurance Company. We have the risk transfer contract. There, the rules of the game are transferred to it. It takes this, goes to the fiduciary agent, brings this contract, and this fiduciary agent will seek out the investors. And naturally, the rule is the same. He has to bring the investors the same risk that I am taking on for Andrina, so that the cycle is complete and there is no kind of mismatch in this type of operation. So both the rule that requires me to notify Andrina, an expectation of a claim, for example, is communicated so that Andrina, in turn, notifies the fiduciary agent, who will then notify the investors that the trigger, theoretically, has been reached, right? So that they are aware that there is something there that, eventually, might require a call on the asset, right? Which is deposited to back this type of operation. Yes, so it's totally matched up. There's nothing different about the deal. And, again, right? The rules for the company's provisioning rules remain the same as originally applied, with the utmost care we take with all the deals we do.
yes. And, in fact, you have a fiduciary agent bringing this level of governance, this layer of governance.
It's that old story, right, Carol? Sometimes, we might end up thinking it's that thing about wanting to be perfect, you know? It's not just about getting it done, it's about making it perfect, right? It's doing the best we possibly can to deliver something that's solid. We're building it now. We want to build it with as much care as possible. Maybe sometimes the urge is to skip a step or two, but no, we don't have that intention. We want to do things transparently, with compliance, with a clear trail, so that everyone can track and trust the business, so that this is the first of many. And, on our side, it's a privilege for our business group, let's put it that way, because we're doing the first opportunity, carrying out the first operation. So, if you manage to do the first one perfectly, you set a great example and it brings more interest from market players.
I think it's important, Lou, for us to highlight here the amount of time IRB dedicated to designing this solution. I think it took about a year.
More than a year, I'd say. The regulation is from 2022. But,
Like, in a more active way.
more actively, maybe a year, a little over a year, regarding this topic. We got authorization from SUSEP at the end of 2024, so in the last 5 months, it's been really intense. This whole deal, this negotiation, so to speak, and the structuring of this operation, better put, but even before that, there had already been some initial approaches and, as I mentioned, we had to show the capital market, let's say, to the financial agent, how surety insurance works, how the operations work within each of those parties involved, so insurance, reinsurance, and retrocession. An excess of loss contract with different laws. It's a lot of new stuff for the market, right? And the market, in turn, said, look, this is how I see it. I thought, wow, so I have to learn. How do you guys also make it so we can have a dialogue that's understandable for both sides? They talk about sidecars, there are some terms like that. Anyway, for me, this is something new too. I learned a lot in this business. I'm very rich, right? I'm very rich. Besides that, we also had, of course, it's public knowledge that we had great partners to get to this point. Yes, who contributed to this institution. We wouldn't have been able to move forward without that. And when I say partners, please, there's no kind of benefit or harm because of the topic, but it's about rolling up our sleeves and working together, because this is something unprecedented. For example, if you were at the Federal Revenue Service, what's the activity code for a reinsurance letter? No idea. This is the first one happening here. It's the first one being registered in Brazil. So, the folks at the Revenue Service, the Ministry of Finance, SUSEP, everyone really put in the effort, so to speak, so that the operation could go through, and they did so within their respective roles. Because it's new for everyone, literally. So, I also want to publicly express my thanks here, because without the professional collaboration of each of these players, we wouldn't have been able to move forward in a satisfactory way. It takes time, because it's the pace of energy. It's something that's happening for the first time, so naturally, it's going to take time. We understand that very well. It's about moving from the realm of ideas to the realm of
action, putting it into practice. At first glance, the idea seems simpler, but when you start structuring it, you run into all sorts of little challenges. Little ones and big ones, right? Actually, the big ones, I'd say. This cycle of mutual learning in the vocabulary, in the way the insurance market operates, the capital market, and all the details, things we sometimes bring up, like, how are we going to implement registrativity?
there are a lot of players involved. The operation is so secure. Anyway, and it's good that it's like that too. There's no complaint about that issue. It's complex, so strong. For example, you have the CVM, you have the registrar, you have SUSEP, and a whole range of intermediaries who provide the necessary security for this operation to be properly carried out, and for it to be sustained literally over time. We make a point of going through all of these steps, really, so that we can pull off this first and not only operation in the market. So, at the end of the day, we're really proud of what we've accomplished and we're looking forward to what's next. Let's see. Let's stop. And for other segments as well, right? Like, not just guarantees. But there are.
A whole range of. There are others.
Where the fit is even better, in my view. Not to talk down my own portfolio, which I work with. But if you put this in the catastrophe market, right? Yeah, in agribusiness. Wow, then you have. I'd say that's the essence of the idea, right? Yeah. The lack of correlation, if that's even a word, right? Non-correlation, or lack of relationship, I don't know. Because here we're bringing in a bit of the financial market. Still, so you
Still end up a bit stuck, right? Whenever any source where you're going to put ILS or LRS, the first thing that comes up is, they're investors looking for assets to diversify their portfolio, uncorrelated ones. Uncorrelated. Uncorrelated. That's it. Uncorrelated to the inherent risks, the familiar ones, that most of the capital markets portfolio is associated with, which are economic risks. And everything else, but you brought up an interesting point, that's starting with A first, more analogous offer makes it easier. Even so, there was a long learning curve, yes, a long one, for both sides. And being a first case that's more similar to what the capital market is already familiar with. Super interesting. So, let's just do a quick recap of the operation that IRB set up, and then we'll wrap up this segment. And then I wanted to ask you one last challenge. So, in the specific case of IRB, acting as the assignor, which is essentially a reinsurer, meticulously makes a transfer to the broader capital market through a specialized purpose insurance company, which is known as Andrina. Andrina, in turn, then utilizes a fiduciary agent, which effectively brings robust governance and competently handles this entire process. The structure, the structuring of the notes, so that it can be accessed by the capital market, by professional investors, and it brings governance by being a third-party entity carrying out the operation. And, in turn, the investor makes the investment, the contribution, and this investment is used to collateralize one-to-one the risk, which is transferred to the capital market. This collateral is held in IRB's asset, which yields the principal at the CDI rate, and IRB covers the risk premium of 2.5% in addition to the CDI, which is the return that this operation generates for the professional investors who invested in the note. And then, finally, this operation remains in effect for a period of 12 months. And after this period is over, there is a phase where an assessment takes place. It's like a cure period, right? You have a cure period too.
See if there was any event that could affect these investors' participation.
That could expose this capital or not. If there is a period where you establish, look, both. The amount of X-rays from this capital was affected by the occurrence of the claim, which is materialized there by the IBNR, calculated by the IRB. And the rules of the game are calculated by the IRB, but based on an agreement made with the capital market, and with the fiduciary agent acting as a governance agent in this relationship. And if there was no claim, the capital market receives the principal back, plus CDI, plus the risk premium. If there is a claim, they receive the financial income, the CDI, plus the risk premium.
If there is a claim, you have to rely on it. And the balance of
Principal, considering that the principal is 1-to-1. If
there is any balance still available after the claim, that naturally goes back to the...
Yes, and it's also important to mention.
We briefly mentioned here the issue of the fiduciary agent. IRB, and RINA, actually, provides periodic updates to the fiduciary agent on the progress of this contract. That is, every month, there's a report showing the status of the established assets, the profitability of those assets, and whether there have been any claims. And RINA also undergoes regular external audits to verify its procedures, accounting practices, among other things. In other words, there is a whole governance process that is also shared with this fiduciary agent to ensure, let's say, greater transparency and to provide even more reassurance to the investor who is supporting us in this operation.
Of course. Great. So, I think with that, we've covered the 4 main aspects of this operation from the perspective that I found important. Really interesting. The first was the tail, the issue of long tail, short tail, and how that was classified. The second is the risk premium, the rate of this operation, which needs to be relevant and attractive for the capital markets, but also makes sense for the assignor. We covered the attachment point, which brings a unique aspect when we're talking about a retrocession operation. And we also talked about being a structure. Loss occurring, how a claim is characterized, providing that transparency between the parties. I think it was really interesting, at least for me, to learn about this. I want to congratulate you, as I already mentioned when I invited you to join our conversation. Yes, really, I'm very proud of the work you all have done. Congratulations. Thank you. It's really great. I love seeing new things happening and problems being addressed, us brainstorming solutions for market situations, the shortage of capacity for the largest companies in Brazil. It's a topic, and seeing the market moving towards solutions, towards innovation, is always very interesting, and I found our conversation very enriching.
Thank you, Carol. And on our side here as well, just a note. Even though I'm here talking about the topic, there's a huge background, a really heavy back office, so to speak, behind all of this, right?
Yes, the number
of people involved in this kind of business, both at IRB and among the external agents. It was a lot of work, it was a real challenge, but in the end, it was totally worth it. I hope this is the first of many, right?
Absolutely. And speaking of the first of many, picking up on that, the last question I'd like to raise is, within Surety Insurance, what other opportunities? Where could ILS be an interesting tool to address this issue of capacity shortage for the big players?
I think that's an excellent question. We've already been designing some deals here and discussing them with the market in a concrete way, because I think large borrowers, depending on their capital structures and economic group structures, have a chance to eventually benefit from this to obtain this kind of capacity. I think, especially because of the independence that exists when you can. To issue a note, in other words, the asset that collateralizes that operation is held in custody by another company. In this case, we're talking about R&B asset. The note is issued by another company that isn't related to that economic group. But I would say that large economic groups that eventually structures that have a need to issue more surety bonds can eventually benefit from their own financial structure, or rather, as a conglomerate, as institutions, so that this transaction runs through them, ending with the issuance of a note. You could have a large borrower who, within that same economic group, has an asset manager, or perhaps another company, and that company itself could eventually, especially just thinking out loud, right? To be a professional investor, and here, actually, you have segregation, right? Of the roles, because in the middle of all this, you have an asset manager, an SSB, that will hold the assets, right? from this operation and a trustee. And in the very large and diverse groups we have gathered here, including all those individuals and communities we diligently protect ourselves from, ensuring their safety and well-being is paramount. Yes, so I think that it is crucial to consider the intricate dynamics and various perspectives within these extensive gatherings, as our collective responsibility extends to safeguarding everyone involved, thereby fostering a more secure and harmonious environment for all.
The big advantage, in this case, of him investing is that he would have to collateralize the operation one-to-one, and the main advantage would be the difference in the yield of this collateral when compared to his own difference. His collateral would be making a judicial deposit.
Example, there's a difference in yield. I think that's a very relevant point, right? If you make a deposit, naturally, the adjustment is by the IPCA, right? But in the case of a policy issued by an insurance company to protect an operation, the adjustment is by the SELIC rate. So just there, you already have an objective gain, especially now, with the SELIC rate. It would be around 15% per year. I think that makes sense, and also in terms of capacity, right? Because in the direct market, theoretically, you already have a capacity limitation for these names, right, to eventually be able to do new operations, which you don't have nowadays, at least so far, when it comes to the bond, right? Since the operation is fully collateralized, and all the assets that collateralize the operation are managed by a third party, right? So, I think capacity is also. That's the main reason for seeking, actually, an alternative structure. And the bond specifically serves to meet this need. So, I think it's possible to structure it. Again, our expectation here isn't to make this operation widespread. It's something that's really made to order. It's totally tailor-made. It's completely tailor-made. We customize each case according to each client's needs. I think that's the goal. Even when it comes to compensation, to add another layer that can also be arranged. You can have a board, people often say it informally, maybe that's not the best word, but it's said loosely, you can have a board set up, a board in which the investor themselves is a member, to, let's say, help guide where to allocate the asset they're making available. It's like a client advisory board. I think that's the right term. Just like there's CRF, the Taxpayers Council, from there on, you could have a client board. You might say, look, I have a large institution here that holds these assets in custody, and I'm going to invest in this type of security. As a client, they can say, no, I agree, let's go ahead together, and so on. In other words, between private parties, you have a lot of freedom to set contractual rules. You can manage things together, working hand in hand. That's why I say the work is really, one of a kind. It's all about the details, tailored to each need, and the possibilities are endless. And that even includes not guaranteeing anything. There are chances to create even more complex scenarios, which we can talk about another time, right? But there are situations even more elaborate than this one. I'm mentioning that these could also work to solve
the issue
of capacity for some of the main clients in the country.
Interesting. Wonderful, Luque. Thank you once again. It was very insightful, the conversation. Certainly, every time we interact, I always learn a lot from you. Thank you once again for joining our podcast. I hope to have you here many more times.
It was a pleasure. Thank you for the invitation. I think I feel proud of the operation, of having taken part in it once again. We always emphasize this. It's the first one, so we take great care with it so that it becomes a reference and not a problem we've created. We're taking every precaution to make sure this is done in the most correct and transparent way possible, so that it truly motivates and drives the market to keep seeking out solutions like this, so we can meet the needs of our clients, the surety bond policyholders. Thank you, and thank you for helping to spread the word as well, because this invitation is really timely. It fits perfectly, since now is the ideal moment to further publicize this new protection option that's being introduced to the market.
That's great. Our podcast is really about bringing up innovation topics so we can dive in, understand them better, learn, study, go deeper, and really work through these subjects in a more in-depth way. I think this conversation was super valid. Luke, excellent. Thank you.